focus on automation. Early on, you don't have to have 100 customers to do this. You can do this with your first one or two customers. And when you're raising money on that information, you're liable for the accuracy of that information. I always like to say, closed one doesn't pay the bills.
I guess just to get started, like you're in the finance space and you've been working with tech companies for decades. It sounds like you're a CFO, correct, of Ingenuity Brands. Maybe you could talk about like what you see and how companies operate and how they should operate, because we work with a lot of startups that are earlier stage and then they grow into larger and larger companies. Like, what's the hygiene of a company and like what should they do early on and then grow into? So like when you jump into a company, it is set up properly.
Yeah, happy to dive into that. First of all, thanks for having me. Glad to be here with you, Daniel, and talk about one of my favorite topics, which is early growth stage finance. What I see most of the time when I come in as a first-time finance person in most organizations is that the revenue has not been accounted for properly and not been tracked properly. And I understand why. It's because early stage founders are so focused on selling. The count the beans part comes a little bit later, becomes a little bit of an afterthought. And while it's totally understandable why this happens, and it's obviously very common, even investors, by the way, I think in some ways enable this method, is because investors are looking for things like ARR numbers, they're looking for things like margins. And so in tracking revenue and making sure that you get from contract signed to recognized revenue properly and it's being tracked properly isn't necessarily something that founders pay attention to. In fact, if you ask most founders, what is your ARR? What is your recognized revenue? What are your collections? Those different terms are not easily understood. And again, we understand why. Most founders are not technical accountants. They're not CFOs. They're product people. They're engineers. They're really good in their space. And so by the time it gets to what I pick up coming in as first-time CFO of any of these companies, what you'll see is that it's on a spreadsheet. It's sitting in, Google Docs or Google Sheets somewhere. There's no real source of truth. There's sometimes a homebrew system. There's not a one place where you can find the contracts. And so the reality is that the founder doesn't really understand what his or her real ARR is and what is real recognized revenue, because I always like to say closed one doesn't pay the bills.
Right. So you're saying that you have to actually bill the customer and track that versus just close one.
And collect. I remember earlier on in my career, I was a CFO of a company that was selling SaaS software to auto dealerships, and over 90 AR was through the roof. And we were in office back then, pre-COVID, and then I was asking a lot of everybody kind of, where how do I contact these customers to get the money in? And nobody could figure it out. And on my way out, the office manager said, "Oh, by the way, check in this one drawer. There's a lot of mail in the drawer." And I checked the drawer and there was 2 years of checks just sitting there. And so,
Wow.
over 90 days could be sitting in a drawer somewhere. You just never know.
That's horrible. I mean, that's bad. If you have the money sitting in your actual office, that's crazy. Okay, so you basically are saying collect the revenue. But when you're a small startup and you're selling and closing deals and winning deals, it tends to be pretty chaotic. You've seen it all probably at this point, just because you've been doing this so long. How does a company even go about collecting? Do they hire a part-time fractional person to do accounts receivable? Do they hire anyone? Does a founder do it? And that's when you say this company's tight and good and it's in a good place. What do you recommend people do in the early days so that we know what we should do, but what would you implement if you were starting your company?
So look, I don't think it's people oriented necessarily. I think early on, signing up for some sort of tool, and today there's lots of these tools available with AI. Obviously, your firm Daniel is one of them. There's others, but signing up for some sort of automated tool where, again, if we're talking B2B, for example, your contracts are kept in the right place. They're turned into an invoice, a receivable is tracked, money is collected. Early on, you don't have to have 100 customers to do this. You can do this with your first one or two customers. I think where maybe the bottleneck has been in the past is that a lot of these tools have a very high cost barrier to get into. If you're just selling your first couple customers, it's really hard to swallow paying $10,000, $15,000 a year for a tool. And so what I recommend to all of the CEOs like yourself is make it easy for customers to bring on one of their, for your clients to bring on one customer. Make that an easy thing, make that cost barrier low so that even that first customer can go through that tool. Now, what also happens if you're able to do this is now you build your business around processes. When you hire a salesperson, when you hire a customer success person, when you hire a finance person, you already have established a process. Versus you don't have a tool at all and you hire all these people and they build a process. Well, now if you're trying to build a tool, if you're trying to onboard a tool later, well, now you're trying to stick a round peg through a square hole, and that's extremely difficult to do. So my recommendation is don't focus on people, focus on automation. And even your first customer can be in a quote to cash system, which is going to be super helpful for you. And, today we have all kinds of APIs and integration. So it doesn't matter if you're using Stripe or even PayPal, it really doesn't make a difference. Start with something even on day one, your first customer. Don't let that turn into 10 before you have to figure it out.
Got it. Okay. So pick tools early, like a Just Paid or a QuickBooks or something that works for you that's like quick and fast and you can invoice and actually get paid from it.
Yeah, absolutely. Absolutely. And, one of the things that everybody is thinking about, well, how am I going to get paid? Well, a lot of times customers will ask and say, hey, can I send you a check? Well, that's the worst thing. You definitely don't want them to send you a paper check, but you'll accept it, obviously, if you have to. But if you're on a system and you can get that ACH or you can get that credit card, well, you don't have to sit on a bunch of. And one thing people don't really know is, yeah, you might be paying transaction fees, but getting those dollars in early also makes money on a checking account. So you don't want to sell your car for gas money.
Got it. Metrics for payment. Is there some good strategy for building out a metrics for payment? Like you pick a tool like a Just Paid. What do you like to see in terms of reporting? What do you like to see in terms of just knowing that the money is coming in or the company is doing well or not doing well? What are your core metrics that you are always putting in place that every founder should know?
Good question. So there's really two things. One is good business practice, which we'll discuss. And the other one is actually being in line with, the right revenue recognition issues that you might have to deal with later. So let's start with good business practice first. I always like to say, get paid fast and pay slowly. So you want your days, the number of days on average it takes to collect AR to be under 90. That's always a good measure. Ideally, you're in the 45-day range. So ChatGPT can calculate that for you. Just drop in your QuickBooks statements and ChatGPT will calculate your AR days for you. It's very simple. Best practice is 45 to 60 days, but definitely under 90 days. And on the payable side, again, ChatGPT can calculate this for you. You want to be higher. You want to be paying, ideally 40 to 60 days. You don't want to be paying your vendors in 30 days. Vendors are going to want you to pay them in 7, 14, 21 days, but you ideally want to pay slow, collect fast. So that's one that I'd say on a business practice you want to be in. On the compliance side, when it comes to things like ASC 606 and revenue recognition, again, early stage companies have to focus on this. If you're not collecting from a customer, but you're recognizing revenue, you could be outside the guidance of ASC 606. And so how did this happen? Well, you have assigned a 12-month contract. You have billed them upfront because that's your policy. You've sent them an invoice. They're sitting on that invoice for 4 months and you haven't been getting paid. And now you're recognizing that first month of revenue. You're recognizing that second month of revenue. You're recognizing that third and fourth month of revenue. And someone calls the customer and says, hey, this invoice has been sitting out there since we onboarded you on day one. And they say, well, we don't know. We don't have a budget for this, or we don't have this in our system. Now you're at risk of not being able to collect that receivables. Well, you have to stop recognizing revenue. And if you're being honest with your investors, that's not revenue anymore. So I would highly recommend that you look at your accounts receivable and make sure that you're recognizing revenue correctly. And that's really more, not even a business practice, that's more of a compliance.
Right. A question for you about ASC 606. Is it something that's required, and when is it required? Clearly, public companies, is it required for public companies? Is it required for private companies? Like, when does startups need to know about it and like understand it?
Again, I'll give you two answers. So the first question is, who's looking? Who's your audience? If you are building a lifestyle business and you never want to raise money from investors and you want to build your own company for yourself, you never have to worry about it. Like, this doesn't make a difference. No one's ever going to look. If you're raising money and you're going out there and you're pitching to investors and you say, this is my recurring revenue, this is my recognized revenue, this is my burn rate, and you're putting this information out there, you have to make sure it's accurate. And maybe you're not being audited yet, but you're definitely putting information out there and you're raising money on that information. And when you're raising money on that information, you're liable for the accuracy of that information. And one of the things that founders do, which I vote against at any cost, is they throw around this concept of revenue. Well, revenue is a GAAP term. It's audited. Don't ever call someone your chief revenue officer. I think that's a misnomer. You're talking about a head of sales. Head of sales is closing contracts. Revenue is recognition. Two different things. When you throw this, oh, I'm in charge of revenue. You're in charge of sales. Revenue is recognition. So even that misnomer tends to make people confused. ASC 606 is important if you're raising money because you're giving out information that needs to be accurate. And again, if you're growing, leaps and bounds, maybe someone's not going to look, but at some point you're going to get audited and auditors will go back to the beginning of time. And if they have to restate your year one, your year two, and you're deep in Series C closing docs, well, guess what? You got to come back and redo all of that. That's the best case scenario. The worst case scenario is you haven't been doing this correctly. Your company shuts down or has a big issue and there's a lawsuit, and investors can come back and say, hey, you gave me information about 2 years ago that wasn't correct. And now you're liable for putting bad information out there. So how do you get over that? A, get good tools, make sure you're tracking things correctly, tools that are compliant, and B, get good people on your side. Today everyone's a fractional CFO, right? Like yours truly. Get someone a day a week to come in, half a day a week to come in to look at these things and make sure that that it's accurate, because you don't want to be stuck on the 11th hour of a Series B close and PwC or KPMG is on your tail about what these numbers look like.
So what you're saying is, if you want to open a pizzeria with no investors, you don't need to worry about ASC 606. But the moment you take money from an investor, the DNA of the company changes where this is required and it's a correct way to like recognize revenue.
Yeah. I mean, even when you tell an investor, we're going to be EBITDA positive next quarter, you have made, especially if it's in a board meeting or if it's in a fundraising call, you have made an accounting estimation. And if you put it in your deck, it's even more official, right? And if you're not recognizing revenue correctly, how do you make that statement, Daniel?
Right.
This is probably overlooked every day and people don't care as much about it until you do.
You notice it more as you raise more money. I think investors get more, they scrutinize more as you, tell me if I'm wrong. Like, say if you do like a family and friends round, they're investing in the people, but as you go for Series B, like you said, I think there's a lot more scrutiny on the company because it's a lot more money from a larger investor. I don't know, average Series B, 10 to $200 million. I'm just putting a broad range on there. Is that the right thinking or no? It starts immediately from the family and friends.
Look, the best practice starts at the family and friends round. That's where you want to have good best practices in place. But it's the Series A and the Series B investors who require a certain amount of governance. You have a board. When people sometimes don't understand this, but board meetings are a legally liable venue, right? So you can't put stuff in your deck at a board meeting that's, from an accounting perspective, not true.
Yeah.
So I'd say by the time you have your first board meeting, you want to make sure your numbers are accurate and in compliance.
Got it. And you brought up what's interesting is you brought up ChatGPT. Are a lot of founders using that to figure out revenue, or are they? Is that even a good tool? It sounds like it's a good
Yeah,
tool.
yeah. No, what I mentioned is, if I say to the founders on this podcast, make sure your days payable is under 90, unless you're an accountant, you're not going to know what that means. But ChatGPT can help you understand that.
Okay,
Where
so it's
are
for
we in
learning.
the, it's
Okay.
for learning. Yeah. Where are we
Okay.
in the world of ChatGPT or, these tools being able to truly do accounting for us? I used to be the CFO at Zenny. I'd say we're getting there. It's not fully there yet. I think there are a lot of people working on it. If you just Googled, or search on ChatGPT AI for accounting, there are a lot of tools out there that are being made, and people are focusing on AI for quote to cash, AI for sales. Now there's AI for closing your books. There are AI ledgers, the QuickBooks killers out there that are raising money to use AI to unseat QuickBooks and NetSuite. All that's coming. It's not 100% there yet. A machine can't close your books end to end today, but we're not that far from it, right? We're on the cusp.
Got it. Got it. Okay. So going back to ASC 606, so it sounds like it's something that's really required as you raise funding. Can you figure out how to do it as a founder, or should you hire in a fractional CFO, or does software do that for you? Is it like built in, baked in to like adjust paid? Like, what do you see out there in terms of like the full scope of like ASC 606, and like how do you stay compliant?
I would say there are absolutely, compliance built-in tools out there like Just Paid, and I know ChargeBee has that built in. I know Sage Intact has that built in. Maxio has that built in. Now these are really big price points, right? I know Just Paid is a much lower price point, which I love, but these are much bigger price points that you want to get into. Still, before you put those numbers onto a deck, having the finance professional give you a check mark to say, hey, I looked at this, this looks right, you're in the clear, I think is a good idea.
Got it. So I guess this kind of transitions us to the next question. Like, when do you get a bookkeeper, an accountant, a fractional CFO, a full-time CFO, a controller, staff members for AR, AP? Like, what's the life cycle you've seen that's been really successful?
Yeah, thank you. So I think either using an outsourced accountant or an in-house accountant, and I'll tell you why you want to choose one or the other. Early on is good because you do need to close your books to be able to raise money, right? So if you're going to talk to an investor, even an angel or seed investor, you're going to need to close your books. And also you're going to need to close your books to pay taxes. Taxes is not something you're going to get away with without doing. So you're going to have to close a month end, and you're going to have to pay your taxes within the first 12 months of being in business anyway. So that outsourced accountant or in-house accountant is really important. The next step is, as you have more money in your bank account, you think about, I probably need a controller level person. If you've got a big sales and marketing organization, you want to think about a VP of finance. And yeah, I think after Series A, when you are 5 million plus of ARR, you really want to start to think about a CFO, either fractionally or full time. Question about in-house accounting or outsourced accounting or AI accounting comes down to, I'd say, the level of complexity. If you are super basic SaaS company with just ARR and your product delivery is very streamlined, you can outsource that accounting. It's not difficult to do so. Most outsourced accountants can come in, use APIs, ingest a ton of data, and turn that on. That's fairly simple. It's when you have a complexity in the business where I think having outsourced accounting is extremely difficult to do. What does that mean? If you've got inventory, if you've got a homebrew system where the source of truth on customers sits on some sort of tool you've built in-house, when you've got crypto on your balance sheet, if you're fintech and you're holding customer funds, all of these complexities require to have someone in-house that truly understands the business and can record your transactions and build you a financial statement that is highly accurate. But if you're a simple ARR business, SaaS company, you can keep an outsourced accountant for as long as you possibly can.
By simple ARR business, I'm like thinking of like
SaaS
Spotify.
software.
Yeah,
Of
just
course,
like
yeah. SaaS software, B2B, B2C. Yeah, very typical. billing systems. Yeah, I think you can keep someone outsourced. It's when you get into the complexities of the balance sheet, or you've got, again, inventory or homebrew systems where you really want to consider someone in-house.
Got it. Got it. Okay. Makes sense. Another question for you. What should people avoid? Like, is there like a lot of fraud that happens in startups? Is there a lot of like bankruptcy that happens? Is there money lost? Like, what are the things people need to avoid? Is it like giving a lot of people access to a bank account or
Yeah, I don't see a lot of that, to be honest with you. I don't see a ton of that. I think where most startups get in trouble is when they don't know how to answer a simple question, which is, do we have enough money to hire the next person? Super simple. I can ask you, Daniel, like, do you guys have enough money to hire 2 more engineers? And the answer to me is never, I don't care what company you're in, is never yes or no. The answer is, if we hire 2 more engineers or 2 more any headcount, what is that a trade-off for? Is it not hiring other people? Is it increasing our burn? Is it adding 2 more months to potential break even? It's always a question of the trade-off. And most companies don't have a operating model in place to be able to answer that question without having to jump through a lot of hoops. Most companies don't have this in place. And so what happens is the CEO doesn't know, what is that additional headcount going to cost in total? How does that affect our burn rate? And the one question that I get so much, and I'm going to come back to just paid in a second. The one question that I always get so much is, I don't know why my burn went up. I don't know why my burn went up. I don't understand why we can't get burned down. Well, you're making decisions without even knowing you're making decisions, because when someone comes to you and says, can I hire 2 more engineers? You go, yeah. We got, I think there's budget for that. But you don't actually know what you're trading off for. And the input of that is making sure that you're collecting on your revenue. Because as I said earlier, close one doesn't pay the bills, right? If you're not collecting on your revenue, you don't even know what your burn rate is. Your burn rate is not your monthly expenses. I hate to tell you. Your burn rate is actually your net income and adjustments for your payables and your receivables. If that's French to you, you really don't know what your burn rate is. So you got to make sure to have a financial professional on your team who can help answer those questions for you. That's where I see most people get in trouble, not fraud or bank accounts or things like that.
how often should a startup meet with that person?
Yeah, depending on size. So I work with companies where, the finance team, me and the finance team get together, 2-3 times a week. I work with companies where we get together once a week. I work with companies where we get together twice a month, just on a regular basis, to make sure that those questions are answered. And also, one of the things, I've been most successful in companies where the CEO is seeking bad news, looking for bad news, asking me, hey, where are the risks? I've been unsuccessful working with companies where the CEO doesn't like hearing bad news, and will tell you to stay in your lane when you bring up bad news. So if you do have a financial professional that you could talk to, and you want to have that experience and you want to have that level of governance, be ready for bad news. But bad news isn't the end of the world. Bad news usually comes with, this is how we can fix it. This is how we're going to get by. We'll go talk to the board about this. I remember I was a CFO of a company once where the revenue totals just didn't make sense because of some homebrew flaw, right? The source of truth sat in some sort of system they had, and the revenue didn't make sense. And they had been telling their board, we have this much in revenue. Within the first couple of weeks of coming in, I knew there was a problem. And I went to the CEO and I said, hey, we got to talk to the board about this. And at first the CEO said, I don't want to go to the board. I don't have all the information yet. The board meeting's tomorrow. What should I do? I said, I think you got to tell the board fast, but let them know we got it under control. Let them know what we're going to do to solve the problem. And so, yeah, that was definitely a situation in which, you want to listen to your CFO or your financial professional.
Got it.